Welcome, everyone. The past 2 weeks have been extremely volatile across global markets. Not just gold and silver, but also stocks, crypto, and virtually every asset traded on an exchange. Despite that volatility, precious metals continue to outperform. Silver is up nearly 8% in 2026. Gold is up nearly 15% in 2026. Both are beating the S&P 500, just like they did in 2025. That's important to remember. Instead of measuring your holdings against daily price swings, it's far more useful to measure them against what you paid, what holding cash would have cost you, what alternative investments delivered. Over the past 5 years alone, holding cash has likely erased 30% or more of purchasing power. Gold and silver have been among the strongest real stores of value during that time. Yes, it's been a roller coaster, especially for silver holders, but objectively speaking, this behavior is normal in bull markets. Big moves upward always come with sharp pullbacks. That's simply how markets work. Rather than panicking at every dip, the smarter approach is to revisit the original reasons for owning precious metals and ask, do those reasons still exist? If prices rise aggressively, corrections are inevitable. That doesn't mean the trend is broken. It means leverage is being flushed out. Speculators get shaken loose, and stronger hands take their place. This is healthy. Instead of reacting emotionally, it's important to step back and evaluate both. Technical signals, fundamental drivers. That's exactly what we'll do today. First with gold, then with silver. Because they are two very different markets. Recent headlines have focused heavily on changes within the Federal Reserve, but it's important to separate noise from signal. Despite public messaging suggesting tighter policy, market expectations for multiple rate cuts in 2026 have actually increased. Why? Because beneath headline GDP numbers, the real economy remains sluggish. Roughly 30-40% of recent growth has been driven by AI-related tech investment. Meanwhile, job openings are at 5-year lows, real unemployment continues rising, many job listings are ghost postings. Consumer demand is slowing. In fact, there are fewer job openings today than during late 2020, and that's before adjusting for fake listings. With an election year approaching and economic momentum fading, the path forward remains clear. Lower interest rates, more liquidity, expanded central bank balance sheets. In other words, more money creation. This has already begun, with tens of billions quietly added back into the system. While retail investors react emotionally to pullbacks, central banks do the opposite. They buy them. Last year, the biggest gold purchases occurred precisely during price dips. This tells us something critical. Institutions view gold not as a trade, but as money. Even government officials are now openly acknowledging that nations are preparing alternatives to dollar dominance. At the same time, major new gold discoveries are becoming increasingly rare. Supply is tightening. Demand is rising. That combination doesn't disappear because of short-term volatility. After last week's sell-off, gold rebounded strongly, closing near its second highest weekly level ever. Technically, the most important level to watch is the 50-day moving average. High momentum bull markets typically stay above this line. Gold briefly dipped below it, then reclaimed it. That's a sign of strength. Additional signals. Futures still lead spot prices. Short selling on gold ETFs has collapsed. Weak speculative hands have been flushed. This suggests the recent correction likely marked a local bottom. Now, could gold consolidate for several weeks or even months? Absolutely. A sideways range between roughly $4,500 and the low $5,000 is very possible heading into spring, but structurally, gold remains in a powerful uptrend. Geopolitical risks alone could accelerate that timeline. Silver is more complex. It's both a monetary metal and a critical industrial input. That makes its price behavior more volatile. Currently, futures markets show massive open interest relative to available physical supply. Even if only 15-20% of contracts request delivery, tens of millions of ounces could be pulled from vault inventories. That creates serious stress. Meanwhile, industrial demand continues rising, driven by solar, electronics, EV infrastructure, the AI hardware. This is not speculative demand. This is real consumption. Asian markets have also been driving much of silver's upside over the past few years, with many sell-offs occurring during Western trading hours. Short-term volatility may continue, especially around upcoming Asian market holidays. Technically, silver remains less stable than gold. While recent pullbacks appear constructive, it's still possible we see deeper retracements before the next major leg higher. That's why keeping some dry powder makes sense. Not because the bull market is over, but because volatility creates opportunity. Importantly, short bets against silver have collapsed. Backwardation has eased. Miners are showing early strength. These are signs that weak hands are exiting. Fundamentally, there is no evidence that triple-digit silver marked a long-term top, but patience may be required. Just like copper's 2025 correction, silver could need several months before reclaiming and surpassing previous highs. Gold appears to be entering a consolidation phase. Silver remains volatile but structurally undersupplied. Monetary policy continues drifting toward easing. Central banks are accumulating hard assets. Industrial demand is accelerating. These trends don't reverse overnight. Could there be more downside first? Yes. Is the long-term thesis broken? No. Markets climb in waves, pullbacks reset momentum, strong hands accumulate. Then the next advance begins. Bull markets are uncomfortable. They test conviction. They shake confidence. They reward patience. If you're feeling the pressure right now, that's normal. Just remember, you don't need to time every move. You need to understand the trend. And that trend, driven by debt, currency debasement, supply constraints, and global instability, remains firmly intact. Prepare mentally for volatility. Stay disciplined. And focus on the bigger picture. Thank you for watching. Take care of yourselves and take care of each other.